Thank you, Mr. Williams. Our next witness is Mr. Robert Murphy, Economist Institute for Energy Research. Welcome.
I thank the chair. I understand we're in a time constraint here, so I'll just briefly summarize my written testimony. I'm going to just talk about what the Institute for Energy Research believes to be the causes of record oil prices, and then offer some possible remedies for that. So I'm an economist. You ask why are oil prices so high? I'm going to say it's because of supply and demand. On the demand side, you've got, as everyone has been alluding to, in developing countries, demand for oil has been growing very rapidly. From 2003 to 2007, for example, in China, its petroleum consumption has increased about 8% per year over that period. And I want to stress, a lot of people misunderstand that, and they say, well, 8% a year is high, but oil has been going up a lot more than that. But the fact is, China's consumption has been increasing 8% per year on average for 2003 to 2007, while oil prices were going through the ceiling. And so the way to compare and say how much has the demand itself shifted in terms of its effect on the price, you would want to say, well, if oil had stayed at $30 a barrel, which it was in 2003, how much more would China's consumption have grown? Okay, so that 8% figure, some people misunderstand the significance of that. On the supply side, from 2005 to 2007, world output was roughly flat. What happened was, as non-OPEC production went up slightly in that period, OPEC production actually went down to almost perfectly offset it. But from the second quarter of 2007 to the present, OPEC has actually been increasing. So the last quarter, we've actually had the highest ever world output of oil, but demand just keeps increasing, and so that's what's put upward pressure on oil prices. The last component of this explanation, which is relevant to today's testimony, is the role of the dollar. So from June of 2007 to June of 2008, oil prices increased about 104%, but at the same time, if you look at the euro price, the dollar price of a euro, that's increased about 16%. So in that sense, we can say, why did oil basically double in the last year? Well, at least 15% of that is solely attributable to the decline of the dollar against other currencies. I just would remind people that the oil is a very fungible commodity traded on a world market, so if the dollar falls against other currencies, you might not see the price of a haircut go up right away, but you will see the price of oil go up, other things equal, because foreign countries can sell the oil to other buyers, so if the dollar falls, the dollar price of oil is going to go up. So if those are the causes, then the question is, what are the remedies? Now, just a caveat, I'm here as an economist advising policymakers of their options. These aren't recommendations per se. There's various drawbacks to these things. There are environmental issues, concerns about budget deficits and what have you. But if the question is, what can Congress do to bring down oil prices, here are some examples. So in terms of conventional resources, we've got 37 billion barrels of crude that are off limits by the government's own estimates on offshore and onshore federal lands. So if Congress removed the moratorium on those, then that's barrels of oil right there that could be developed and bring down oil prices. Also, if Congress legalized oil shale development, there's some 800 billion barrels of resources available according to government estimates. That's 3 times the amount of reserves that Saudi Arabia has, so there's plenty of U.S. oil supplies, and the question is just, is the government going to allow American companies to develop them? Finally, what can the government do if it wants to raise the dollar's exchange value and the foreign exchanges? Of course, the Federal Reserve could raise the target rate, but also Congress could lower income tax rates. That increases the after-tax return to U.S. assets, and so investors around the world would tend to flock into those assets. For example, during the first Reagan administration, after those tax cuts went through, the dollar soared on the international exchanges. Thank you.
Mr. Bernanke, when he was here last week, about the price elasticity of oil, and he put forward the idea that a 1% decline in demand or a 1% increase in supply would result in a 10% change in the price. I would ask each of you to just give me your best number. I know it's an unfair question. I know there are lots of caveats, but all things remaining equal, a 1% increase in supply or decrease in demand would have an effect on supply of how many percent?
I echo most of what they said. Right now, a 1% increase would roughly double or more than double world spare capacity, so yes, that would have a tremendous effect. 10.378%, if you want a number.
10.387. I like that precision.
We have Canada that's drilling right off its coast, Newfoundland, all along its coast. And I am told that at least 400,000 homes are heated by natural gas that comes from Canada. One, is that correct? And two, tell me the negative impact of their mining and drilling off their coast on the Atlantic seaboard. Mr. Williams or Mr. Murphy? Mr. Murphy.
I'm not familiar with the imports of gas from natural gas from Canada, so I really can't give you a good answer.
Mr. Murphy, can you jump in here?
I can't definitively confirm that, but those numbers do sound plausible to me, and to my knowledge, there have been no adverse impacts, environmental, from that operation.
Let me start by asking you about the Strategic Petroleum Reserve and a release of oil from the reserve. Let's start with our first witness. Can you give me some indication as to how this will impact the price of oil? And if it is a significant impact, I'm going to assume that it may have some positive impact on the dollar.
Yes, I would just echo those remarks that it's certainly, you increase the supply in the market, the price goes down, but there's only 2 to 3 months of net imports in there, and if something happens in the Middle East, you might want to have that supply for that reason.
What could we do in addition to the release of that oil to have a continued impact on the price of oil by helping with the demand side?
You want me to focus just on the demand side?
Well, I'm assuming that we release the oil from the Spro. What in addition to that should we do?
My personal view would be that you would allow for energy companies to explore offshore and onshore federal areas that currently are illegal.
Now, if we do this, the exploration does not have an immediate impact. Let's assume for a moment that it will have an impact, notwithstanding the fact that we import far more than we can generate by drilling. What will we do to have an immediate impact on the price? Because this is a question that the people I meet in my district will ask me. What are we going to do about oil prices now? We know that we can release from the Spro, and that will have an impact right away, hopefully. What else can we do right now?
Well, I just would challenge the premise of that what happens is, so it's true that if you allow for offshore drilling, that physically won't hit the market for 7 to 10 years, but what would happen then is producers right now with excess capacity, knowing there's going to be more competition in the future, would increase production. And we saw when President Bush lifted the executive side of the moratorium, and that week alone prices fell almost $16. Now, there were other things going on in the news, but I think that certainly had an impact. Another example, Saudi Arabia in May refused to increase.
Before I go to another person, and I appreciate your comment, let me just add one more thing. If you say that this is, and many of you have said this is demand-driven by virtue of China and other countries desiring more, that demand does not seem to be subsiding for oil. And if this continues to be oil-based and the demand continues to escalate, are you confident that what you're saying about the speculative aspect of this causing the prices to decline?
What I'm saying, though, is not purely speculative. That, like I said, Saudi Arabia did in May refuse to increase when President Bush asked, and then a month later reversed themselves. And I think partly why they did that is the political climate here changed, and they realized it's much more likely that there's going to be 1 million barrels or what have you a day extra down the road, so we should
10 years down the road.
Right, so we'll pump more now.
Let's move to Mr. Williams.
Question to Mr. Murphy. I think it was last week when Federal Reserve Chairman Bernanke was here, before his testimony. I believe it was my colleague from California, Mr. Sherman, asked him a question, and the Federal Reserve Chairman stated that 1% increase in supply could lower prices by as much as 10%. Given when I listened to your testimony, you're talking about supply and demand, and the demand rise of China and India and Middle East, it's going so rapidly. Do you agree with Mr. Bernanke that relatively small increases in supply would have a significant impact on hypersensitive markets?
Yes, I would agree. Everyone realizes that the oil market, it's very price inelastic, meaning even as prices have gone way up, people haven't cut back consumption very much, and so it works in the opposite direction, that if you increase the available product, even a small, what seems to be a small amount, that could have a dramatic effect in the short run.
Would you also then agree that a small drop in supplies, a pipeline problem in Nigeria, a strike in Brazil, a statement by someone in the Middle East has the same but opposite effect?
Right, spare capacity right now is about 1.5 million barrels, so anything like that could really drive up the price of oil.
Well, I appreciate that.